Hello, friends. Welcome to the Nexus podcast. I'm your host, James Dice. Each week, I fire questions at the leaders of the smart buildings industry to try to figure out where we're headed and how we can get there faster without all the marketing fluff. I'm pushing my learning to the limit, and I'm so glad to have you here following along. Before we get started, here's a quick note from our sponsor. We've talked about the importance of occupancy data over and over on the show, and the team at Butler would like to reinforce it. Occupancy data drives a variety of use cases across workplace experience, real estate planning, and facilities management, and is too valuable to be siloed in a walled garden. Every building and workspace would benefit from accurate, private, cost-effective occupancy data accessible via API. So go to www.nexuslabs.online/091 or click the link in the show notes to listen to Nexus Podcast episode 91 with my conversation with Rags Gupta, president of Butler, on their approach to provide accurate, API-first occupancy data at a fraction of the cost while not being physically able to collect personally identifiable information. This episode is a conversation with Joe Aamidor of Aamidor Consulting and Jeanne Casey of Nuveen. And if you add me in, you get 3 J's, or J cubed. This is the third installment of our M&A Roundup series with J Cubed, recorded in mid-October 2022. This time we heard from Jeanne again about general trends in the market and in mergers and acquisitions, then unpacked a few of our most recent interesting acquisitions in the industry and dove into why they happened, our reaction to them, and other trends they're related to. Before we jump into the conversation, I want to make sure you know about our new Thought Leader program. Once a month, from now on, I'll be co-writing a piece with one of our sponsors. We'll dive deep and make it non-salesy and educational and tell stories that are outside my core expertise. I'd love to partner with you on one of the pieces coming up. Check the link in the show notes to learn more. And without further ado, please enjoy this Nexus M&A Roundup. Hello, Joe and Jeanne. Welcome back. This is our third M&A podcast. How are you guys?
Hi, Jeanne.
Hello. Very well. Excited to be here for the third time for the three of us.
J cubed. All right. Let's, for people that don't know this series, that haven't listened to the previous episodes, let's do a couple quick self-intros, starting with you, Jeanne.
Sure. My name is Jeanne Casey, and I am the head of prop tech and innovation for Nuveen Real Estate. We are a very large investment manager, one of the top 5 in the world. And my role is 2-part. So the first, I come from a background in venture capital. I've been investing in startups for over a decade and prop tech startups for going on 5 years now. So that's part of my mandate. We're investing in early and mid-stage prop tech companies. The other part is I'm head of innovation. So I play a role with each of our sector teams, helping them to prioritize different prop tech initiatives and tech initiatives and work very cross-functionally with our IT teams, our sustainability teams, lots of folks internally helping make better connections between the prop tech world and Nuveen Real Estate.
And you and I did a podcast with just the 2 of us, and we'll put that link in the show notes for people. It's a great episode. Joe, how about your intro?
Yeah, Joe Aamidor. I work in the smart building space. My background is very much in product and market strategy, product management. I work for myself, focused on product and market strategy for startups that are looking for help within that. They might not have a full-time product leader, so I can help on specific things there. Do a lot of work with investors, usually commercial due diligence on a specific deal. Sometimes it's a strategic buyer of a technology product. And then I also do a fair bit of work with owners and operators, usually somewhere in the vendor selection process, I guess, if you think of it from identifying companies down to selecting a specific company or a couple to pilot. I go very deep on smart buildings within my work.
Cool. And this series, of which this is the 3rd episode, we unpack what's going on in the broader prop tech and smart buildings industries from an economic and VC perspective. But we're also going to do a little deep dive on some of the interesting M&A deals from the last quarter. So our intention is to keep up this quarterly cadence. So let's dive in. Let's start with a macro discussion. So Jeanne, your little monologue last time received a ton of, I got a bunch of emails from it, like the mic drop, the golden mic drop that Jeanne dropped last time was heavily well reviewed.
No
So
pressure.
no pressure. I don't mean to build that up for you to do it again this time, but I thought we could just start with sort of a general, what's the economic environment in which startups are sort of playing today? And again, this will go live middle of October 2022 for those of you that are either listening in the future or for Eugene, just to know that that's when you're going to be talking to people.
Thank you for that qualifier. So if this is all wrong in like 3 days, then that's why. All right, so a little bit of pressure here. Versus last time. I actually don't think there is as much really heady news to report. I think it's actually a lot of the same. And if I had to sum up like one word to describe the state of the world right now and all the indicators that are relevant to our business ultimately, that word would be uncertain. And that's sometimes a lot harder to navigate if you're a founder, if you're a venture investor, than decisively bear market where we're staring down 6 to 12 months of a recession, most likely. I think the mixed signals we're getting from the economy, the stock market, are reasons to expect good news in the future, but be cautious as well. So a couple of just quick hits from a very like macro econ nerd kind of perspective. Interest rates are up quite a bit since we last convened. That was not unexpected at all, but as a reminder to those who don't follow econ and didn't major in it in college like I did, VC valuations and startup valuations do not like high interest rates. So this is reason to expect we have entered a new paradigm for startup valuations that's likely not going to change meaningfully and revert back to that frothy environment anytime soon. The August jobs report that just came out was down quite a bit. We lost about 1 million jobs versus a couple 100,000 in previous months and over the summer. And so that is some indication that the Fed increasing interest rates may be starting to have an impact. So that might mean there will be fewer rate hikes in the future, which is a good thing for startup valuations, or at least like expectations into the future. And so everyone's hyper-focused on what's going to happen or what these are going to have impacts on inflation. That's what the Fed and everyone is trying to, as best they can, control. The stock market has been reacting to all of this news, bouncing around a little bit in recent months. I think we could, with some medium confidence, say maybe finding a floor, which is good, and bleeds over into VC and prop tech startup sentiment, because private markets follow the stock market. The quick hits here are fairly similar to last discussion we all had, but I would say the stark difference in sentiment that we described last time. So everything is slowing down. We're down, valuations are down anywhere from 20 to 40 to 80+% sometimes when you're looking at prop tech SPACs. That all still holds, but it's a little less jarring because we're comparing to the last few months that were already off those lows. So pace of funding remains slower, sizes of rounds remain smaller, valuations remain at that lower paradigm that's, I think, unlikely to shift or change anytime soon. Sentiment has soured, I think, for prop tech and smart buildings generally, but that's not, I think that's comparing with all-time highs and not so dissimilar from the overall startup and tech environment. And so I think that's really important to keep in mind. And on many measures, we're back to where we were in like 2018, 2019, when we're talking about rate of M&A announcements, VC funding. And that was a fairly healthy, environment we're talking about. So I think this is all a expected reset. And the scariest thing for founders is this, prolonged likely prolonged period of uncertainty where we're not really sure, what's going to happen headed into 2023. It's not all doom and gloom, but there are what I would call a lot of low probability, but like potentially really high impact events that could happen, whether they're geopolitical, whether they're climate related, whether they're, macroeconomic related. I think all of that is kind of hanging over our heads as investors, as, founders, as folks in our industry, and is all important to keep in mind. So let me pause, not as quite as mic droppy as last time, but hopefully gives a little color and, curious what resonates with you guys and your day-to-day. And James, I know you just launched a syndicate, so I hope you're now tracking a lot of this stuff like I love to.
I'm going to start, going to you for these sorts of things. It's definitely not my expertise. I think I have two questions for you. One of them is, if I'm a VC, which I sort of now am, which is the weirdest thing ever to talk about, and we'll talk about the syndicate in just a minute. If I'm a VC though, I'm looking at, my broader portfolio and trying to hit, the power law, which is I'm trying to hit big, huge winners. Do I really care? How much do I care as a VC what is happening to, valuations here and there? And then can you answer that same question from the founder's perspective? Are they feeling it for some reason, and how do they feel it when valuations get a reset like this?
Yeah, no, that's a really great question, and not a straightforward answer. And also, welcome to the VC club. That's a fun one. So I would say yes and no. The macro environment matters. Long term, it doesn't. Short term, it does a lot. I think from a funder perspective, for a VC perspective, we want to see our portfolio companies and potential, future portfolio companies really focus in this kind of market and not, cut burn rates to an appropriate amount, raise an appropriate amount of money at appropriate valuations. So when you hit a turbulent time and you're not able to grow at the pace, you were previously, or raised at around that indicated you had to kind of really outgrow the valuation hanging over your head. We would like to see folks buckle down, no extraneous spending, really focus on their core value proposition, because, and I'll get to this in a little bit, but from, putting on my Nuveen real estate hat, like my owner hat, and potential customer for a lot of these companies, we're also feeling the macro environment. And so you got to know your customer and understand that they're also cutting costs, slimming the list of priorities and the new things that they're willing to experiment with in a really choppy macro environment. So I think it is really important to operate, but that doesn't necessarily mean completely change your vision. I think it means being a smarter, still having that crazy great vision to, be one of those power law fund returning companies, while being a savvy, operator, to weather the storm to get there. Because if you can't build a boat that's going to weather that storm and come out the other side sailing, I'm not a nautical person. I don't know if that analogy quite landed. But if you can't build that boat and you just take something, small out on really choppy waters, that's not going to end well. And so we're always looking for, or at least myself as a VC, I'm always looking for that great combination of visionary, but also pragmatic person able to execute.
Makes a lot of sense.
Yeah. And, it's funny. As you were talking, Jeanne, actually you and James, just a couple of weeks ago was Blueprint, the conference, the second year of the conference. And last year, anyone who attended, there were a lot of startups there. There were a lot of investors there, and everyone, it was very enthusiastic. It was at the end of the year in 2021. And that was kind of a representative sample of the current state of the market. I talked to people who said, oh, we found our next lead investor. We're not raising for another year. And this year going into it, I thought, well, one, I just knew who was attending, so I knew it would be a good event. But I was also curious, what's the enthusiasm level we'll see around raising money, and on both sides, right? I have money I want to spend on startups or put into startups. I am a startup. I want to raise money. And I actually think it was still pretty enthusiastic. I don't think it was as enthusiastic. And I took away from that kind of this sign one. I think everything you said about uncertainty is correct, but there's these two sides of the market. And then there's, well, within buildings, not very data driven, not generally speaking, not very tech enabled yet, a lot of room to grow there. And then you add on the fact that, well, from a climate sustainability point of view, that's really where there's a big bang for your buck if you're trying to reduce emissions. So you're going to have these two things. I don't know that they're colliding necessarily, but we're still at this point where there's a lot of reason to be putting money to work in this market.
Well, that perfectly brings up my second point that I was going to ask Jeanne in this sort of overall economic, section of this conversation, which is buildings still need to decarbonize.
Right.
There's a ton of ways in which technology can help real estate organizations during a downturn, right? So to what extent are smart buildings sort of insulated from these broader sort of negative economic trends, Jeanne?
I think somewhat, but not entirely. I think you can make that argument, that, insulated argument, for any really great venture-backed or backable company building relevant technology that has found product market fit, or at least like market fit. And so there definitely is still venture capital money out there for those great companies building great products. And back to my, my owner hat and Nuveen real estate hat, there's still customers out there willing to pay for really great smart building technology, especially technology that's going to help decarbonize, cut costs, have a really clear value proposition. It's less about like, oh, shiny new object, lots of marketing words, like this is an AI driven platform using, all the latest and greatest words, really about, communicating a value proposition. What is this technology going to do for your building or portfolio of buildings? And why should you buy it? What is the ROI? I mean, it doesn't have to be, the cost of this, the cost savings you're going to get from this technology minus the cost of the technology is your ROI. It's really just crisply articulating what the business case is. And so, just quickly to feed that back into what I hear and feel as like the venture capital perspective and sentiment in the market right now, there's definitely still VC money out there looking for those great companies. And so I think there's still, and especially in the smart building space, I think there's still, I bet my career on this space, prop tech more broadly, a bunch of years ago, and still have that conviction. It kind of, has only grown over months and years that I've spent in the space, because there's just so much low-hanging fruit still, out there ready to be addressed. But there is a slower pace of deploying capital. There's deeper due diligence of all these companies. So I think as long as you're building, as long as you check the boxes I just kind of laid out, clear thesis and value proposition, you're building tech to address something that's real, that's a need of real estate and a building owner or a building operator, you're going to pass this deeper diligence with, maybe it's not as quick flying colors as it was 6 to 12 months ago, but I think all of this is good for the market that maybe got a bit overheated. And then anecdotally, if this is interesting, I think we've reverted a little bit to more thesis-driven investing. So with the slower pace, I'm talking to more investors that are kind of digging up their old theses that they've worked on and more proactively reach out to companies in a certain space they're really interested in. I think that's a really healthy and like great thing. I love to think and invest like that. And so it's almost, when there's not such a frenzy where, you have to make a decision in less than 2 weeks if you're going to, write a check to a company, having that extra, I don't want to say like extra time, like we're just sitting around twiddling our thumbs, but being more thoughtful with and like deeper in how we're thinking about a company or a space, I think is really great, especially for like where we are in the maturity of the whole space. And then finally, I'll just say it's kind of interesting, even despite, the slower pace, a little more reserved nature of VC funding in the space, we've seen some like fairly sizable and interesting strategic activity printed in the last couple of months. And so I'll just call out, CBRE's massive round in VTS, and NVIDIA's $15 million investment in Passive Logic, I think are worth noting, because I don't know if we mentioned on the last podcast, but there's definitely been some talk like, oh, corporate VCs are going to really pull back in this, choppy macro environment. We're not necessarily seeing that, which I think is kind of interesting. I mean, I don't want to speak too soon. Obviously, there's many months for lots of things to play out, but interesting to note.
Yeah, it's I agree, and I would say there is, anecdotally, I can share. I've seen still a lot of very small companies. People will reach out to me. I 100% welcome that, anyone listening to the podcast, just to talk for half an hour, talk for 45 minutes. Seems like there are small companies out there with ideas that are still not really, they're pre-revenue, but maybe have line of sight to some near-term revenue, that seem to be raising not a lot of money. I would say it isn't an unrealistic sum of money, but they're raising some money. They're able to get things going. And I think that's also a sign that we're not in a position where everything has stopped. You sometimes listen to discussions of, oh, back in the .com bust, there was just nothing happening for months or a few years. I'm not seeing that. I do see some startups that seem to be a little bit more careful on what are they spending, or might be, they might refer to, oh, well, we want our CFO to sign off on more than normal just to make sure everything checks out. Or so I'm seeing some signs, again, anecdotally, of what's going on, but it's by no means let's just things are still moving, if you will.
The piece I'll add to that is just, having launched the syndicate 2 weeks ago, almost 2 weeks ago, not even 2 weeks ago, just seeing so much outreach from either rounds that have just been closed, that, the lead investors reaching out to Nexus saying, can you participate as a strategic?
Yeah.
So I'm seeing deals that haven't been announced yet that are good for the market, good for the smart buildings ecosystem. I'm also seeing a ton of startups that have really, really good traction that are looking to raise their next round, which is an amazing thing to see. So I guess I'm not feeling like things are slowed down, but I have no context for how it was in the past either. So it is it just feels like there's a bunch of just mixed signals right now, if we can summarize, that uncertainty word.
Well, and one quick point that we had talked about before we started recording, you have Metaprop, for example, had their PropTech Confidence Index. I think that's a semi-annual, not half annual, but semi-annual survey data from entrepreneurs, from investors, and they showed it being very low. To be totally frank, though, and we were discussing this, it came from an all-time high, right? So there's really nowhere to go but down. So you could argue, yes, things are not as confident, but that doesn't mean there's no confidence. Those are very different things. And then there was another article, I think, others have probably seen it as well. Bill Gurley was interviewed by McKinsey, and he was talking about, this is a great time to build. A lot of people have said that, not so much within PropTech, but when there's a correction, all the points that were made. If there are layoffs, that is unfortunate, but there's talent out there that is maybe now easier for you to get, because they can't just go work at the biggest company that has, the most secure jobs. That might cause some people to say, oh, maybe I will try my time at a startup. Maybe it'll be a great opportunity. So there's that. There's less competition to actually participate in rounds, more time. I mean, I think as you were speaking, Jeanne, the thought that popped into my head was, there's nothing like economic contraction to focus the mind. I mean, I think, that you could argue that's to some degree what's happening. So there's a number of positive things happening as well.
Can you guys expand, either one of you, on why a downturn is a good time to build a little bit more? Like what was Bill Gurley saying in that article? Yeah,
so he brought up a couple of different points. But for one, you have less to worry about your competition, right? So if you have 3 core competitors, the likelihood that one of them is going out and raising a huge round that will fund sales and marketing, if you all have the same product, or you all have maybe not the same product, but you all have a product that is as viable in the market, you could argue that company that has more money to hit the street, more salespeople, more marketing dollars, they stand a better chance. And I've even heard from some companies, not I would say now, but over time, that have said, our three competitors all have much bigger bank accounts right now than we do. We're really not going to be able to beat them because we just haven't raised that much money. That maybe is coming up now with other firms that are looking at M&A because we weren't able to raise last year when we would have been able to raise. All of our competitors did.
Mhm.
Now we can't raise as much, so we don't think our prospects of competing effectively are as great.
So that's not necessarily like the best time to start a new company.
Well,
more survival of the fittest.
Gurley's interview did kind of say more like this is a great time to start a business, but I think it was access to talent, less competition, both for talent, for just hitting the market and trying to sell. This kind of point of focusing the mind, being more from a constraints mentality. I can't spend money on everything. I don't have enough money to spend on everything. That can really focus you on product market fit, on really solving the core problem that your current customers or your future customers may be most interested in solving.
Totally.
So there's a number of dynamics that I think that interview was a little more focused. At least my read of it was starting a new company from scratch. He may also, given that it was in McKinsey, he may also have been speaking to people who typically were at a big company, maybe were laid off or looking to leave because they're worried about getting laid off. And I think his enthusiasm was, well, you should think about starting a company. Also, and I don't have all the data, if you look at past downturns, there have been some very, very, very successful companies growing. Airbnb and Uber out of the last downturn. And those are only two of,
many.
A few handfuls. Yeah.
Yeah, I think in general, resources are cheaper, and that scarcity mindset, forces that focus, like you said, Joe. And so when the market does turn, you can really, if you're able to, navigate to come out on the other side, you can really just double down and really start scaling once you've refined that product market fit. Have built relationships with early customers, have hired some really great talent that you maybe didn't have access to when, everyone was raising massive rounds and offering crazy high pay packages.
Yeah.
And also, again, this is not great, but there's been a lot of layoffs at tech companies. And so there are more engineers looking for jobs. And then also, an interesting additional thing, and Gurley mentioned this in the article, is the whole rise of hybrid work. And that's super relevant to all of us.
Right.
And so being able to cast a wider net from a talent perspective, I think you both are really interesting examples of people who have really specific, deep skill sets that don't necessarily live in like the major, what people think of as the major tech, like metro hubs, but have incredible followings and have built, brands for yourselves. I think that carries over to startup world, where especially in the smart building space, if you're looking for someone with a specific skill set, they don't have to be like 20 miles from your office. And also office space is cheaper.
Yeah.
Not for nothing.
Shout out to Smart Buildings, Colorado. Yeah. We did the Nexus happy hour in Denver last week, and it was so some great smart buildings leaders outside of the main metropolitan areas, definitely.
Yeah, I will say I've been pleasantly surprised at how much there is a very solid tech ecosystem. Not San Francisco, not New York, not Boston, but I've been to multiple conferences, and there were two, I think, last year where the first person I met also lived in Boulder, which was totally coincidental, obviously. But there's private equity here, there's VCs here. But I think that that's what you're seeing broadly. I think if you went to Austin, if you went to Nashville, if you went to Miami, if you went to, those are not core kind of hubs.
Totally.
But hybrid work certainly fits in. Yeah.
I did want to circle back on the people that, if anyone's listening to this that lost their job recently, reach out to us. We have scholarships for both our course and for the Nexus Pro community. It's honestly the best place to find a job. If you're already listening to this podcast, you're going to be able to find somebody that's hiring within the community. So yeah, reach out to us. Like I said, scholarships are available. Are we ready to switch gears? Any other points on macro discussion?
Really quick one that I think is a nice note to end on, and it goes back to your point or your question, James, around how insulated is the smart buildings industry. We're seeing already a pretty quick flight to quality for when I'm talking about real estate investors as well as tenants. And so again, putting on my Nuveen real estate /owner hat, Investors are looking to put money behind, if they're going to invest in the office sector, they're really looking at those top of the line, class A, amenity rich, tech enabled. There's almost like an arms race to get there. Those kinds of buildings, which are, have smart building and prop tech, opportunities written all over them. And from a tenant perspective too, even with hybrid work on the rise and the reduction in space, like need for space, tenants can arguably pay a bit more per square foot for some of these really high quality buildings that are super tech enabled and, low carbon as well. And so they're starting to think of, where they're spending money on space as being, a perk or, an amenity as gathering in person becomes more and more important. So I think that's unique to the smart public building space. And is going to set up, the space to come out of this, potentially prolonged uncertain period quite strong, because those are trends that are definitely not going away.
Right.
Totally.
I think the two kind of next step takeaways, that's absolutely right. I mean, if you Google flight to quality, there's been articles in Bloomberg, Wall Street Journal, Brookfield had an interesting report where I think they actually were tracking some of the trends behind this. So like the data indicates this is true. Talking to people indicates this is true. The two thoughts I've had about that, the flight to quality, one, I think it's known that means a lot of Class B office space is probably ripe for being converted, maybe into multifamily is where you typically go. But there's also, in my mind, I've thought the buildings that would be buying smart building tech are the Class A buildings. Anyway, that's probably, if we wanted to classify it, early adopters. But what happens if there's more stress on the Class B and C buildings, where that would be your late majority? 5 years from now, is that the late majority? And overall, does that compress the size of the smart buildings opportunity? I don't know the answer to that. That's just one of the things I've thought. It might accelerate for the near term, but not get us to that same TAM that we would have had, 5 years ago when, Class A, B, and C were all occupied by office workers.
Just good food for thought.
I was throwing it out there. Time will tell.
Yeah,
absolutely. So sort of switching gears to M&A, I think one of the ways in which I'd like to sort of transition into M&A is the question to you guys is, given these market conditions, do you guys see companies sort of failing to raise money that they need to continue their operations that are in, the smart buildings world, and therefore they need to get acquired sooner rather than later? Do you think that's sort of and this is the last projection to the future we'll start to talk about what's happened in the last quarter in just a second.
Anecdotally, I'm seeing that selectively. I think it's for companies who maybe built really cool technology that didn't quite find the right fit or target market or infamous product market fit, and weren't able to raise enough money to have a long enough runway to find it. I think that's the simplest explanation and way to categorize the companies I've seen recently, kind of not be on necessarily fire sale, but you're more on fire sale the closer you are to a zero bank account, obviously. And so I've seen, anecdotally, the whole range of folks starting to explore, hey, I really wanted to, go it alone, sites on an IPO years from now, but maybe a nice, high double-digit, low triple-digit $1 million sale is a really nice exit. But I've got 12 to 24 months of runway to see if, the former outcome is still possible, all the way to, I've got, less than 6 months in the bank to pay my people. We've got to engineer something that's going to be painful for employees and previous investors, unfortunately. So I think it spans the gamut.
Yeah, I would to some degree agree with you, Jeanne, but I don't think I've seen enough examples to really build a signal out of the noise. The two things I will note, more dynamics of our market. One, you just have probably too many companies in a lot of the common smart building categories. So when there is a downturn, it's the Warren Buffett quote, when the tide goes out, you see who's swimming naked. I don't think it's exactly that, but some of these companies have been able to continue to fund their operations through raising capital. because they've been able to be successful enough. Now, I think the bar of how successful do you have to be to raise more money is, again, a little bit higher. And there are, I think, just too many companies doing the same thing out there. And so that maybe they merge together, that maybe somebody acquires a few of them to build, to really buying market share versus buying a lot of technology or product type acquisition. There's that dynamic. But the other side, which is related, oftentimes the model, you build a product, you hit product market fit, and then you're raising money to put money on the sales and marketing fire, right? You're trying to build that fire and trying to just talk to more people. What I have seen generally, it's hard to bring long sales cycles in our market for a variety of reasons. We don't have to get into all of them, but I think there are companies out there that raised money that have spent, probably in retrospect, too much money on sales and marketing, and where they expect it to be, we're raising now, we think it'll get us 2-3 years of runway. We expect our revenue to be at some level. And that's, I think, generally the math that a lot of investors and startups will be doing. I think you probably are not quite, there's not a consistent ability to get to those numbers because it's hard to bring those sales cycles in. So I still talk to people who just kind of are almost resigned to the fact, oh, I know it's going to take me 9 to 12 months to close a deal. And sometimes when I hear that, I think, oh, that if I was investing in that company, that's what I would look for, right? Because they're a little more realistic. The market is the market, hard to bring those sales cycles in. But the flip side of that is you might have spent a lot of money on sales and marketing, might not have gotten where you needed to go, and thus, you're in a bit of you're more trouble maybe than you would have been.
Yeah, I'd say more. Usually, it's more like 18 months. Also,
right? It could be. Yeah, it's more to the long side than the short side.
Totally.
Yeah.
All right. Cool. That was great. Thank you for that. Let's pause here for one more quick word from our sponsor, and then we'll get back to the show. I'd like to introduce all of you to Sam Kovar and his company, Tietoa. Tietoa is an acronym for Take In Everything, Take On Anything. And after participating in the Nexus Foundations course, Sam got hooked on smart buildings, and he wants to Tietoa anything our industry can throw at him. As an outsider, he sees a future where this industry can move forward faster with better communications. He wants to be an independent, creative resource for helping you guys, the Nexus community, connect to their customers and grow your audiences. He's got 15 plus years of experience in strategic communications, creative consulting, technical execution for video, animation, and photography. So connect with Sam using the link in the show notes and learn more. Let's dive into M&A. Joe, do you want to start? You do this in your newsletter every month.
Yeah.
You track this in your spreadsheet that everyone can access, and we'll put in the show notes. Can you just talk about all the M&A deals that have happened recently? Yeah,
I'll just quickly run through all of them. And I forgot exactly where we finished last time, so I'm just going to start at the beginning of June and just go through. So Iotis, which is a smart home platform, they were acquired by ADT. ADT is, interestingly enough, in the news. They just received another investment from Google and I think also from State Farm. I think now if you are a ADT subscriber, the kit they give you is all, used to be Nest, I guess now they call it Google Home. HQO bought Leesman. Leesman is kind of a standards and consulting group for workplace experience. There's a certificate, I think you can be a Leesman AP, accredited professional. So they made that acquisition. Schneider bought EV Connect, EV charging. I usually cover it because it is related to smart buildings, but you could argue is a little bit different. Johnson Controls bought Tempered Networks, very much a cybersecurity deal. Siemens bought a company called Brightly. Brightly was actually a very new name of an old business called Dude Solutions. They used to be School Dude, then they changed to Dude Solutions as they expanded beyond schools. They changed their name, I think, late last year, maybe to Brightly, and they were acquired by Siemens. Clear Result bought a company, EcoFit. It's more residential energy efficiency services. Deepki, this is one I think we'll talk about later, bought Fabriq, which was more Deepki ESG generally. Fabriq, more of a smart building platform. A couple getting a little technical and kind of niche-y. KFI Engineers bought Staggs and Fisher, an MEP engineering firm. One of the things we've talked about this, a lot of independent mechanical branches, mechanical engineering firms are getting bought up and rolled up together. A lot of private equity money behind that general thesis. Energy Capital Partners acquired Metris Energy, generally in the energy efficiency as a service bucket. Actually, a week later or so, Partners Group made an investment into Butterfly, again, energy efficiency as a service. I'm going to mess up the name here. Engie had spun off a business called Equins. Engie, obviously big French utility, has a lot of energy services operations. Equins was their facility services group. So they had bought a few businesses in the Northeast, in the US, in France as well, France and Europe. But Bourgeois, I think is how you pronounce it. It was a French facilities company bought Equins. So Equins had been spun off and then shortly thereafter was acquired. HQO, there's a just as Jeanne, you mentioned, Seabury and VTS, HQO and JLL are kind of tying up in a variety of ways. JLL invested in HQO. They've merged the Jet product into HQO. So my understanding is if you were a Jet subscriber or user, you're now going to, moving forward, be on HQO. Sea Power in the demand response space, they bought Centrica's US DR business. Evermore Industries bought Avuity. Avuity is in the space utilization space. They make a space utilization hardware and software solution. Carrier finalized, I think, the acquisition of Toshiba's light VRF and light commercial HVAC. They had been partners for maybe up to a decade, but for a very long time. Every US HVAC company has now, in one way or another, has tied up with a Asian, usually Japanese VRF business. So basically the idea there is VRF is really disruptive to overall traditional HVAC in a lot of ways, even before electrification. And so every US HVAC company needs and has acquired or partnered with usually a Japanese HVAC company. And they had been partners, but I think Carrier has now made the acquisition to own that part of the business. Envoy, which hybrid, well, they started as kind of visitor management, but now they've gone beyond that. They bought a company, Office Together, which was a little more focused on desk booking, hybrid work software. Omer's private equity bought Pueblo Mechanical and Controls. Again, Pueblo was built up by a private equity firm, and now it's been sold to a larger private equity firm. Spark Fund bought, and this was covered, EPX Group. EnergyCAP bought Wattics. Wattics gets them more interval data. This one we might be talking about. Measurabl bought WegoWise. We'll talk about that one. Robin bought a company, Flow and Form, which I was not familiar with, but it was Robin actually very similar in a lot of ways to Envoy. You could say direct competitors. Flow and Form was a little bit more beefing up the tenant and occupant experience. And then just a couple of weeks ago, Generac bought Blue Pillar, which also is very interesting. Generac has been very acquisitive. A lot of the acquisitions they've made, though, I tend to think of them more on the residential side, whereas Blue Pillar very much commercial industrial. And that was a mouthful.
I love it. Love it. Obviously, we could go deep on all of those if we wanted to. And we haven't done research on all of those, but I'm pretty sure we could talk for like 5 hours on that whole list. Yeah. Thank you, Joe. You're like the encyclopedia of smart buildings M&A.
Yeah. Every once in a while, I'll just note, every once in a while, I'll get an email from somebody that says, can you give me edit access to the list? And I usually try to be nice and ask, well, do you need just a copy? And a lot of times it's like, oh no, never mind. I'm sorry. Like, oh, but it never seems like it's a company that says, can I go in and change something in your list? It's just, so I probably, for anyone listening, will not give you edit access to this list just because it's a nice resource for the industry, but.
Yeah, it's going to be like on GitHub soon.
Yeah.
Okay, so what I'd like to do is sort of draw a little nice circle around the Measurabl and Deepki acquisitions, and maybe we'll get into EnergyCAP and Wattics a little bit and just call it like ESG consolidation sort of thing, right? And by the way, when this episode goes live, the previous episode will be with Matt Ellis, CEO of Measurabl. Shout out to Matt. He's probably listening to this one now. He's a big fan now that we're covering all these Measurabl acquisitions. So Measurabl follows up Hatch with WegoWise, right? That's the main acquisition that happened in this quarter. Last episode, we talked about Hatch data. Maybe I'll just start with since I had Matt on the podcast last week, what he told me. This one sort of represents, if we think back to Hatch data and how that represented an expansion across the user journey. So they were doing mostly reporting and data acquisition. Hatch lets them expand into interval data, expand into FDD, expand into more action in decarbonizing. So if you think about the whole decarbonization journey, they're now able to span more of that than they were before. what he told me about WegoWise is it's a little bit different. It's one, expansion into new customer base, right? So WegoWise has a big multifamily user base, right? I think he told me 1.6% of all apartments in the United States use WegoWise, and so it's a pretty big chunk of users to acquire for sure. But then he also told me, and this is interesting for us to discuss, I think, was more vertical integration. So while Hatch Data was horizontal or integration, this is more vertical integration in terms of the tool set that WegoWise had built around attaining and automating the access of utility bill data. And I think this is interesting because last time we talked about how Arcadia had bought Urjanet. Well, who's one of the biggest users of Urjanet? Measurabl. And so part of one of the reasons why I think that happened is, okay, now Matt views Arcadia as a potential competitor, which I think we'll get to in a minute. Now, how do I then cut Urjanet out of the stack? Which is, I think, a very strategic move there. And I think it relates to them also spinning out a data platform as part of one of their product offerings at Measurabl, which is, again, in direct competition, I think, with Arcadia's data platform as well. So interesting moves. I see those two as a very, they don't have the same data set, obviously, totally different. They have utility bill data, but they're both sort of spinning out this data platform or, API as a service type of approach. And yeah, you guys have any thoughts there?
Yeah, I'll add a couple quick ones. The other interesting thing about WegoWise, they were owned by Appfolio, and Appfolio is one of the larger multifamily real estate operations platforms. They have a variety of different solutions capabilities, and I think that acquisition was made 5 or so years ago. But WegoWise does give them both the horizontal growth, new asset class, you could argue, similar use case, but new asset class, but then also that vertical, being able to collect more data on your own. I also just think it's another sign when you look at and Jeanne, you probably have more to add to this, but if you own a lot of real estate assets, the first kind of step was you were being asked, well, I need to be able to disclose current energy use. And what does that mean in carbon? The conversion is not so complicated, but that was the first step. But then, of course, there's the bigger question. How do you reduce? How do you drive, get to net zero or get on your way to net zero? And I think before these acquisitions, Measurabl didn't really have a great answer to do that completely. Hatch definitely gets them there. But you could argue WegoWise helps too, because if they can more quickly get more data, that's at least the top of the funnel of, well, we can start helping you benchmark. We can help you start measuring. And then, of course, we want to stick with you and be the platform to help you actually decarbonize. So that's the other bigger question I've heard from some real estate owners, operators who've just said, we're really still trying to figure out how do we get where we need to be.
I have a question for you guys. It's a little bit not off topic because I don't want to derail too much, but like just as you're talking, something occurred to me, and that's I typically see tech trends go from consumer markets and like the multifamily or housing sector to office and industrial and other commercial sectors. It seems like sustainability, and I'm just going to say like sustainability instead of broader ESG trends might start more in office and commercial. And this, do you think it's like a false flag to view this WegoWise acquisition as kind of office leading in this area versus multifamily? Or is this just like, a random noise, not necessarily signal? But it's just interesting and a little bit counterintuitive to the way tech trends, I think, usually proliferate across real estate segments.
Yeah, I had not thought of it that way, but I actually think that does fit a little bit. I mean, my sense, again, anecdotally, but my sense is where if you own or invest in real estate, the office was maybe the first questions you were getting, what are you doing? If we're an investor in a fund that is investing in real estate, a lot of the focus was let's decarbonize the office buildings. Moreover, the office buildings are usually the more complex buildings compared to a multifamily, compared to even warehouse would be another big institutional asset class. just there's so much complexity in offices. Getting to net zero, I think you could argue, is more difficult to do, and there's more work from just collecting all of the data, analyzing all of that information, that would lead you to say that that's where the first focus has been, starting with the trigger of sustainability, but then leading down the path of, okay, well, we know our footprint, we know our current performance, what do we do about it? So I think that actually, I hadn't thought of it that way, but I think that actually fits.
I think people think that there's this like black and white, like residential and commercial, but there's really this like, broad spectrum from, black to white, right? There's on the full end of the spectrum, there's, the consumer industry, which is single family homes. And on the full other end of the spectrum, there's, owner occupied office buildings, and like landlord owned multifamily assets probably sit somewhere in the middle, right? Where it's like you have the consumer, which is the apartment renter, and then you have the commercial landlord, which is the building owner, and it's like right in the middle. So I don't know. I think it's like kind of like the asset is both in a way.
Yeah, that's totally fair. And I mean, at the end of the day, even an owner occupied office building is trying to please its end user of the space, which are humans who also are influenced by consumer trends and want nice things.
Totally.
So that's cool. Just curious what you guys thought.
That's a good question.
Yeah, it's absolutely. So one of the other deals, is assuming there's nothing more on the Measurabl piece, the other deal that looks like this, or at least maybe looks like Measurabl buying Hatch Data, was Deepki buying Fabriq. And Joe, I wanted to see if you had more of an idea than I do about sort of what Fabriq was doing, what sort of use cases they were really good at before the acquisition.
Yeah. So Deepki, European based, I think France specifically, they're based in France. And they were very much focused on ESG reporting, data management. So very similar to Measurabl, but in France. Fabriq, I think based in London, a lot of references to just pounds, not dollars. They were certainly in the interval data category, although I would say they're a little different than Hatch in that I think their platform was a little wider. There were references on their website to integration with indoor air quality sensors. We're seeing this growth maybe in the past year or so of companies that I would describe, or that they would describe as smart building platforms, right? Any data, so any IoT sensor you have in an office or other type of building, we can pull it into our platform. I think we'll see more of this. The challenge with some of those platforms is that they go really wide, but they don't go really deep. So sure, any streaming data you can put onto a simple trend analysis type visualization. You can build certain types of graphics, reports that will make sense regardless of what that streaming data might be. But you could argue there are specific things you might want to do with indoor air quality data versus energy data versus just occupancy data. Where are people? What is the trend over the day? So Fabriq specifically did go a little bit wider. There are references to being able to connect to a lot of different IoT sensors, but they also talk about smart building data analytics, so maybe touching fault detection to some degree. Challenge, some of these terms are used, and I wouldn't say it's erroneous to use them, but there are James, you and I would say fault detection means something very specific. It isn't just there's more energy being used today than yesterday, there's something wrong. That technically, I guess you could say you're identifying a fault, but it's not really fault detection like the damper in that.
It's just a measure of how much it's diagnosed.
Yeah, exactly. So it's similar in that you're going from big picture portfolio wide help with ESG reporting to a platform that now gives you much more granular data. And I think that's where the story converges between what Measurabl has done and what Deepki has done.
Yeah, and I think where it converges to is similarly, right? Just kind of building on what you're saying, is you have a reporting software expanding into more use cases than just reporting and starting to become more of a comprehensive platform, for lack of a better term, also raising a lot of money. So Deepki's raised a heck of a lot of money as well to sort of fuel these acquisitions.
Right.
And it's starting to look like a similar pattern, right? Where I've raised over $100 million, and now I'm starting to buy adjacent competitors to sort of build up this larger platform. And one of the things I think is interesting about that, when you have these two, one based in Europe and one based in the US, well, who are the other sort of other categories, right? That if these are becoming, these two are becoming a category of their own, I feel like the other categories are like the big OEMs, the big four, the big, large conglomerates in the industry. They're going to start competing on sustainability or ESG with Measurabl and Deepki. So that's one category. And then it feels like another category, if that's like up above these companies, down below these companies is all of the singular point solution startups that are out there trying to compete on, like you were saying, Joe, I do this thing, this deep thing, or call it FDD or whatever you want. I do that better than the more comprehensive platforms. So it's almost like there's now three categories in this ESG space that I think is really interesting. And it seems like we're going to see, if we think about like future M&A, the big guys trying to maybe then acquire Measurabl or Deepki, but then both Measurabl and Deepki acquiring more and more startups to sort of keep building out this, more comprehensive platform.
Right. I also think at the top, to add to the framework you were describing, you have the big facility operators, facility management companies. They are involved in some cases in sustainability, maybe from a consulting point of view, but they are also, and we're going to talk about this later, but they are also making technology investments. You could even argue energy services companies, which generally is maybe the most nebulous category because it can mean a lot of different things. But there are a lot of companies out there, maybe they're part of a utility, in another country, and they're they're just a deregulated component of that business here. And they're saying, we can actually retrofit your buildings. We can actually help you participate in demand response. We can do all the actual, the things that will actually are not just technology, right? But like services, technology, the whole enchilada. They can actually drive reductions, both energy savings, dollar savings, carbon reductions. So there's a lot of entities that are big, multi-billion-dollar industries. I think any of them would look at this space and say, there's some acquisitions we could do here that will build out our business, to add to your framework. Yeah,
no, that's a great point. Yeah, and maybe to kind of build back on what you were saying earlier about the acquisitions that happened, like Spark Fund buying EPX Group. Spark Fund is one of those examples of that, energy as a service or sort of tech-enabled ESCO sort of model that would be in that, the bigger category as well. Maybe that's a fourth category, not to add more categories to the framework there.
Yeah.
I'm not an expert on the Europe market necessarily, but I think an interesting dichotomy that I think exists, and curious if you guys have any additional insights, but the prop tech and startup market is a few years behind, I would say, the US prop tech startup market, just in terms of maturity and amount of capital that has been raised, just like raw number of startups out there. But there is, I'd say, a larger push from limited partners who are investors in real estate funds on down in ESG and sustainability requirements. So there's arguably, like, Europe is arguably ahead in this area. So I wonder how, like, is there as fragmented and robust of a startup market in Europe where these companies, have kind of a plate full of options to acquire in the coming months and couple years? Or is the fact that the market over there is potentially a couple years behind, make it a little bit more sparse?
The only thing I have to go off of here is my vendor landscape, which has 458 companies last time I checked. And there's still quite a few, like a ton of, when we're talking about this whole user journey in each category that we've been talking about, there are still a ton of European based companies across that user journey. And I'd say I probably don't track the European market as closely, and so I'm probably still missing some. So it does feel like, even though they might be behind, if you think about like fault detection diagnostics, for example, Clockworks 2008, Sky Foundry 2008, Iconics before that, right? So those companies have been
around that time.
Yeah, there aren't like the European equivalents of that history, right? But there are still quite a few, utility bill, interval data startups, like those types of things where you see, and HVAC controls, sort of AI type of companies. There's a bunch in that value prop. So yeah, I do think there are still quite a few to be acquired for sure.
Yeah. My perspective to build on that, it seems like the companies in Europe do take a bit of a stronger position around the sustainability side of what they do. Whereas in the US, you still have a lot of smart buildings companies that if you're meeting with them, they'll explain to you, well, we help you save energy. We can help give you an estimate of the reduced energy based on analytics, maybe our platform identified. This is the carbon equivalent, but that's not really a full enterprise scale or even building scale carbon reporting platform. It seems like the companies are certainly positioning themselves a little bit more as we do that, but we want to talk about the fact that we also can help you with sustainability. I also see a little bit more fragmentation in Europe by country or maybe by region. You could argue maybe all of Scandinavia is I know it's not a country, of course, but there are companies that maybe are focused in that market. England is a little bit detached, Germany a little bit detached, Spain, there's companies focused on Spain that I think they would tell you we have clients across the continent, but it seems like as an outside observer, the companies are a little bit more entrenched in their home market. Whereas in the US, I guess you could argue there are some companies more focused on West Coast versus East Coast. I still think that's probably less of a case. And I don't know that it's a language barrier. I don't know, a lot of these companies, at least if I meet a company from Europe, they'll usually tell me or I'll ask them, they've internationalized to some degree their platform, so it works in different languages. A lot of those countries, English is pretty dominant as a second language anyway. So I think there's some differences, but I tend to agree there are a lot of companies in Europe.
Joe, real quick before we I want to kind of zoom out on this real quick, but you mentioned EnergyCAP buying Wattics.
Yeah.
What do you feel like that fits in the same theme?
Yeah, I think it's largely a similar theme. It's a little bit different. So EnergyCAP it started, and I think they spun out of Enron a couple years ago. So it was a business within Enron, but they've been independent obviously for decades.
And it's more K-12 higher ed.
Yeah, so the market focus, I tend to think of it as the MUSH market: municipal, university, school, healthcare. Some people call it the HUGS market, which I think is funny. Hospital, university, government, school, but it's public entities. I wouldn't say that's exclusively where EnergyCAP works, but a lot of their customers, and that can be a good market, one, because there's far fewer companies that want to go sell to a lot of school districts or cities or states or counties. But there's actually a lot of communication between them. So if you do well by a couple school districts, it's likely all the others around you will call you and say, hey, we'd like you to help us too. Where they really focused and went very deep and had a very strong platform was within the utility bill management piece. So this is the accounting side of, I have utility bills. You think of any of those entities, they have a lot of buildings, maybe not big buildings, but a lot of buildings, and usually every building has a bill. So they could aggregate all that together, provide a lot of insight into, are you spending more? Are you spending less? Are there errors in the bills? Have you paid the bills? But they didn't go so deep on interval data. And Wattics really brings in that interval data capability, which again can be used to actually identify what's the root cause of my energy bill being so high this month. Just seeing utility bill to utility bill to utility bill, it can be very difficult to diagnose that. Wattics was a little bit wider in focus. They weren't exclusively focused on the MUSH or HUGS market, but a lot of the capabilities brought together there would be applicable to a lot of different building types and asset classes.
But if we compare that to like what Deepki and Measurabl are doing, this acquisition doesn't take EnergyCAP along the full user journey. It's just utility bill and meter data, which is I think, you could debate the importance of that, but it doesn't feel like as comprehensive of a platform.
I'd say that's a fair point. There is, when you look at one of the big pieces that Measurabl has been very good at solving, really for the legacy of the business, was the reporting out to all of these voluntary, GRESB, SASB, the whole host. Energy Star reporting is more simple, I would say, less labor intensive. When you get into the MUSH market, there's just less of that, right? I don't know a lot of. EnergyCAP is always a requirement, but I think that makes the ESG reporting or the sustainability reporting story or use case just less common when you get outside of institutional real estate,
right?
Which is one of the reasons why when you compare them, that isn't maybe addressed quite as much by this combined EnergyCAP Wattics.
Totally. But if you have EnergyCAP and now they bought Wattics, I'm still sitting here as an energy manager saying, man, I still really need fault detection diagnostics. Like I have to go out and procure something else to get that at that point. Is all I was saying. Yeah.
Oh yeah, no, and that's fair. The funny thing I'll add to that, I oftentimes when I run into conferences or just have like catch up calls with people I know, I oftentimes ask them, so between buying a solution to solve all your problems or buying point solutions to deeply solve individual use cases, I still hear, again, anecdotally, but I still hear both very smart users and deployers of these technologies take one or the other side. I think there's not a great consensus. I'm going to do it this way or that way. Eventually, maybe there will be, but
especially when you have such a broad spectrum of what people mean by these different capabilities. I mean, we teach this in the foundation, in our foundations course. When someone says they have FDD or they have something else, right? There's a very broad definition of what that means. Just because you're able to check that box doesn't mean you're satisfying what different users need.
Right.
So I wanted to sort of zoom out a little bit on this category. And when I say this category, this might be all of the time we have to discuss. This might be the only category we get to discuss today. But do you guys feel, and I'm kind of looking at this as not only a total nerd in this category, but now also an investor, do you feel like there are more room for new startups across this user journey when you have platforms like this that seem to be raising a ton of money, acquiring competitors, consolidating, developing out new features, right? What are your thoughts around what white space is there from a technology standpoint? And do you have any confidence that a new startup along this user journey somewhere can be a good investment for a VC, given that they might just get snapped up immediately by a Measurabl or a Deepki? What are your guys' thoughts?
Jeanne, do you want to go first?
Yeah. I have two quick thoughts. The first is I think there's always room. And I think when incumbents raise too much money, get too big, get a little complacent, maybe that's when there's, the certain opportunities are ripe for entry and a little head-to-head competition. It's hard to maintain that like market leading position over many years or decades even. So I think generally the answer is yes, still more room. I think there's less, I think we're also going to see where that white space kind of opens up after this wave of consolidation that I think is going to take quite some time to play out, just because transactions take a long time. Funding rounds take a long time. All this stuff takes a long time. So I think we'll have a better sense of where in the user journey the opportunities still remain. And I'd say towards the end, like the actual project-based like decarbonization initiatives and enabling building owners to actually decarbonize is still relatively white, if not white, light gray. And I'd say that is a particularly exciting area as an early stage VC.
Totally.
Sure.
Yeah, I agree with those white spaces. I think the specifics that Jeanne, that you just mentioned, I think also just from a architectural point of view, it's still really hard to get data out of buildings. It's still really hard to make sense of that data. It's still really hard to take a lot of different buildings with different control systems and maybe separate metering infrastructure and maybe lighting control systems that have some interesting and useful data in them. It's really just hard at scale to bring all of that together. Makes it challenging in a lot of ways to be a seller of a vendor, if you will, of these solutions, because you can even go into a new building and not really know how long is it going to take us to get this building up and running. And we'll give you an estimate, but I saw this when I was on the vendor side. We would be held accountable sometimes for things that really weren't our fault, not pointing fingers at whose fault it was, but if it takes 4 weeks to get a list of buildings and what kind of meter they have in the buildings or what's the metering infrastructure, you really can't do much if you're an interval data startup until you have that. But if you've told a customer, oh, we should be able to do this in 2 to 3 weeks, and they, but you can't also turn around and say, well, you didn't get, you don't want it to be adversarial as you're starting foray into a new client. But that's an area where I think we're just going to continue to find problems or gaps, white space that I hope more and more startups will enter the market to solve. And some are. I shouldn't say that it's 100% white, but
you guys are making me feel good because the Nexus Syndicate will be investing in this space. So I just wanted to put it out there and see if you guys can validate me for a minute. But yes, Joe, I 100% agree with you. Jeanne, 100% agree with you too.
Yeah.
The white space around projects and we've talked about this a lot on the show in the past, and I've written about this, making a decarbonization project happen. There's still so much to be done there from a product perspective, in my opinion.
I think also demand flexibility is one where there's a lot happening big picture. A couple of years ago, I remember there was, I think it was GSA they have the Green Proving Ground, and I think they were starting to test. They came up with the acronym, right? GEB, Grid Interactive hyphen Efficient Building. Hasn't been a lot happening there, all in all, you could argue. And I would also argue it's a little, when I talk to different people who talk about grid flexibility on the building side or on the vendor side, I don't know that it's quite as defined as maybe some of these other categories where, if you and I can say, like, we know this is what fault detection is, whereas grid flexibility can mean a lot of different things, especially depending on what assets you have in the building, both generation and
to your point earlier, in order to make GEB happen, which I think that's how I pronounce it. Yeah. In order to make GEB happen, you still need this, horizontal architecture with the ability to integrate with control systems and sort of have a cohesive control strategy. All the stuff that we already talked about, you need to enable that concept for sure.
Right. Yeah.
Well, we're gonna have to save the rest of the list for a future podcast. Let's close this down. Any comments on M&A before we do our last carve-out round?
I don't think so. It's always fun to talk about this in this type of format. So,
yeah, I think the theme that we started out with, uncertainty, I think holds true throughout this discussion. But there's lots to potentially be excited about too. So,
all right,
still an awesome time for the space and to be in the space.
Totally agree. So let's do carve-outs. You guys haven't given a carve-out for the last 3 months, so hopefully you found a new book or TV show or podcast. But anything you guys can share that have sort of made an impact on you in the last couple of months?
I just finished reading a book, has nothing to do with VC or smart buildings, so breath of fresh air, I guess. From my usual day-to-day consumption. Educated by Tara Westover. It's a memoir. It's absolutely incredible. If anyone out there hasn't read it yet, it's about a woman who grew up with no education, didn't go to school until she managed to get herself into college and went on to get incredible graduate and PhD degrees. And she comes from a very interesting family and religious upbringing. And it's just an incredible story about the power of education and thinking through complicated family stuff and dynamics and psychology and mental health. It's a really incredible story and memoir, true story, I guess.
Awesome. What about you, Joe?
Yeah, I'll share one. This is a book that I want to read, but I listened to a podcast last week, I guess. So Steve Case, as we all know, we probably know from AOL, he wrote a really interesting book 7, 8 years ago called The Third Wave. And he was talking a lot about, I guess, what others have called the Fourth Industrial Revolution. But I guess he just wrote a book. I think it's called Rise of the Rest. He's been, for the past couple of years, really trying to build out an infrastructure. And it touches what we've talked about with hybrid work, of course, an infrastructure in other cities that have startup hubs or build out startup hubs. His fund, he has an actual fund. He's investing in a lot of those secondary, tertiary markets, I guess you could call them. He probably would not like that term. But the interview with him was really interesting. And I think the book just came out last week. But it seems like an interesting theme as somebody who grew up in the Midwest. He mentioned, I have to note, I think 2 or 3 times during the podcast, Indianapolis is like one of those newer startup scenes. I mean, you could look at it and say yes, but yeah. So it was just kind of interesting interesting book on my list, at least.
Cool. And then mine is just my continued self-education on VC. I read the book called The Power Law. It just came out this year.
Yeah.
It's like the history of VC. If you hear the name Sequoia and Benchmark and on and on and on, just understanding who those people are and what the story was, how they started, why they're successful. Some of the really interesting stories around, Uber kicking out the founder and CEO, and Airbnb and everything sort of getting off the ground. There's so many good stories in there. So of course I, devoured that on my honeymoon a couple of weeks ago, and I'd definitely recommend anyone that's remotely interested in startups, check that book out. It's great.
That is a great book. One of the analysis I read of the book was that not only was it really just well done, but Sebastian Mallaby is the author. He did a great job of picking the right stories to tell. Because you could argue he goes from, he's like a decades long journey from 70s, from when, Fairchild Semiconductor was a big business that people had heard of, and that start, and also just kind of interesting stories of VCs where you used to be a journalist and now you're a VC, and that's not actually that uncommon. It's probably in the grand scheme of all the VCs out there, but it isn't like now you have somebody who's gone from journalism to VC, and that you kind of forged that path. Mm-hmm. So a lot of interesting kind of anecdotal stories like that too that fit into a broader trend.
Totally. All right, you two. This closes out 2022. We'll have to do this at the beginning of 2023, and hopefully there's less uncertainty by then. We'll see.
Yeah.
Unsure.
Yeah.
We're unsure. All right. See you later. Thank you.
Thanks all.
Bye.
Bye.
All right, friends. Thanks for listening to this episode of the Nexus Podcast. For more episodes like this and to get the weekly Nexus newsletter, which, by the way, readers have said is the best way to stay up to date on the future of the smart buildings industry, please subscribe at nexuslabs.online. You can find the show notes for this conversation there as well. Have a great day.